Welcome to the SaaS Revolution Show. Sean Ellis, author of Hack and Growth and co-creator of Go Practice. Welcome, Sean.
Thanks, Alex. Really good to be on with you.
Yeah, great to have you on the podcast for the first time. We've been running SaaS Revolution Show for 5 years now, and I've been following your career, growth hackers, and read your books, Hack and Growth, which you mentioned in the intro. So really pleased to have you on the podcast for the first time. Pick your brains, for the community. So pleased that you could make it.
Absolutely.
Good stuff. And I can hear my dog Betty. She's pleased as well because she started to.
I'm waiting for mine to start barking too. The joys of working from home.
Indeed. So look, Sean. I know you very well. I think even though we haven't spoken, but from following you in the companies that you've been working from. For those members of the audience, perhaps that don't know you, tell us a little bit about yourself and who is Sean Ellis.
So there's kind of an interesting philosophical side to that question. I just got back from a meditation retreat, so I'll try to not go down that path. But the high level of who I am. So I spent most of my career building and growing companies. So started in the mid 90s, invested kind of everything that I had, just a year out of school, but I'd been in a sales job where I made some pretty good commissions and put it all into an internet company in 1995. So that turned out to be a pretty good investment for the first one. And that was Uproar.com, where I ran marketing from kind of customer zero through a NASDAQ IPO filing. We built, Uproar was a game company that we built to be number, I think it was 7 or 8 overall in the world in terms of total usage time. And we were the #1 game site. And so that was sort of how I got started. And a lot of it was just figuring it out as I went. I wasn't sort of classically trained in marketing. And then we sold that business to Vivendi Universal, and same group of guys started a company called LogMeIn after that. And LogMeIn, I ran marketing from customer zero through a NASDAQ filing. 6 months after I left LogMeIn, I joined Dropbox as the first head of marketing, and it was an interim role. So the reason it was interim was that I learned across the 2 companies that I'd spent about 10 years in that my most important contributions were in the first 6 months. So I really wanted to get good at that stage. If that's the most important time, and in a 10-year period, I only got to do it twice, I wanted to try to figure out a formula where I could do it multiple times. So I did Dropbox, I did Eventbrite, and Lookout. So those are 3 companies that all reached that unicorn status, and obviously Dropbox and went well beyond that. And even LogMeIn actually sold back to private equity recently for about $4.3 billion. Then Hack and Growth was really writing everything that I learned about that. My co-author on the book, Morgan Brown, worked in growth at Facebook. Now he's VP of growth at Shopify. And so our combined experiences in the book, we got a really good publisher behind it, and it's published in 16 languages. And so the book's done really well. And that's really fed kind of what I've been doing more recently of just, keynotes and workshops and trying to just help high impact companies or companies that have valuable solutions provide a lot of impact. And so that's what I've been doing more in recent years. And then also launched a simulator for learning growth with so it's called Go Practice with Oleg Yakubinkov, who was a former data scientist from Facebook. And that we only launched that about a month and a half ago, sort of a recreated with both of us. And so that's also been a lot of my focus recently.
So tell us a little bit about that. And obviously, again, impressive, a very impressive CV there, and various sort of companies, running your own companies. Now you're doing it again. With Go Practice as a co-creator. I've not really heard of a simulator
right.
software for like learning, a skill. I guess why not, right? But simulator for learning growth. Tell us a little bit about why you decided to go into this project and launch this company.
Right. Yeah, it is really different from anything that's out there. So Oleg actually created it first for the Russian market, and then translated it into English and had it available. And I came across it and was super excited about it conceptually, but I saw some areas where it could be improved. And so I worked out something with Oleg where we would partner on it. And the whole idea is that when I look at all of the growth that I learned, I mentioned, in 1996, there weren't really books to read on growth. So I learned by doing. And when I talk to everybody else who's had a good track record in growth, most of them also learned by doing. And so instead of having a course that's all around the theory of growth, we wanted to do something where you actually, so think of like a flight simulator, but you're put into a situation where you're responsible for growing a business, and there's a storyline through it. So you come in as a junior analyst and the product has just done a soft launch and you're analyzing the data. So it's actually built on top of data in Amplitude, and you're running queries and making decisions, and there's a whole storyline that ultimately you get promoted to a chief product officer, and you're essentially helping to iterate the product to product market fit and build a really valuable company. But even just going through what Oleg had built, my data skills probably tripled. And data is just such an important part of growth. I didn't have product management skills really before that. And so it really strengthened my product management skills. And I think what I'm finding is that to be successful in a data analyst role, in a marketing role, in a product role, in a growth role, you actually have to be good at all of those. And that's pretty tough, but with this type of course, I think you can really build the skills and strength to be good at all of them. And so, yeah, I'm excited about it. We've actually, so if you take what he's had on the Russian side and the US side, 7,000 students have gone through it. And the relaunch has been awesome. So the other thing we're doing is running it as a cohort. So each week we get together and do a deep discussion. So yesterday we had all the people in this cohort doing a full deep dive on retention and how to model retention and how to forecast growth and retention cohorts and benchmarks for different types of industries and different products. And so I just, it's a lot of fun working on it. I've enjoyed it.
It sounds like a lot of fun, and I'm sure there are probably many CEOs, and I'd be very curious for taking it as well. But how long does it take? Let's say you mentioned, let's say, like from a junior analyst to a chief product officer from the simulation. Like, how long does it take you to kind of get through that on a simulation?
Yeah, so I mean, it's self-paced if you don't want to go through the cohort. So the cohort is basically 12 weeks, and so it's a pretty intensive, hard course. I think a lot of people sort of think, oh, I'm going to go after hours, crack a beer, sit down and start working on this, and they think, oh crap, I got to do this with like fresh morning brain, not with a beer in my hand. And so it's about an hour a day for 12 weeks. It depends. Like certain sections, if you have really good Excel skills, you're going to get through it a lot faster than if your Excel maybe is a little weaker and you don't know the formulas to do some calculations. But it's very data heavy, and but that's what's required to be successful today in most businesses. And so learning those data skills is super valuable.
You led marketing and growth, as you said, at 5 different unicorns. Dropbox, LogMeIn, Uproar, Eventbrite, Lookout. What are the biggest similarities that you've seen across those, and biggest differences you've noticed when scaling growth at these companies?
Yeah, so it is interesting because there's quite a bit of variety in the types of companies I was working on. So game community for the first one, SaaS companies for LogMeIn and Dropbox, and even Eventbrite, SaaS, and then Lookout, mobile security app. And that, so you would think, okay, they're all going to be pretty different. In fact, after I left Uproar and was kind of figuring out what I was going to do next, a lot of headhunters were saying, oh, we just don't have any game companies. I'm like, I'm not even a gamer. I just, it was a really elegant business. I like the gaming side of things. And so I think what I've learned on the similarity side is that there's kind of a set of principles that govern growth in almost any type of business, at least in an engagement business. If it's purely a transaction business, it might be a little bit different. But if it's, like maybe like a dating app where once you make the match, ideally they go and get married and you never see them again. Tinder maybe changes that dynamic a little bit. But for most of these companies, it's about acquisition, converting someone on the must-have use case that ultimately is going to lead to long-term retention. And so how do I drive that engagement and retention? And how do I drive referral off of that? And so that's pretty similar across almost every business, is just being able to understand value and map your value delivery engine, and then have a rapid test learn process for accelerating growth in the business. And so, even like, I haven't worked on e-commerce, but I came across a quote by, in fact, I put it up on my wall. So Jeff Bezos at Amazon, our success at Amazon is a function of how many experiments we do per year, per month, per day. And so that's definitely something that I found as well, is that you don't learn until you experiment. And the more experiments that you run, the more learning that you get, and generally the more growth that you get. And obviously you need to be constrained by statistical significance. And if you experiment in high leverage areas, that's going to make a bigger difference. So I would say the similarities are much bigger than the differences, but some of the differences, I think, part of it, like Uproar, I was making it up as I went along, just kind of figuring it out. By the time I got to Dropbox, I had much more of kind of a playbook in mind of, okay, these are the things we need to do, and this is the order in which we need to do them. And so I was really deliberate. In fact, it was in my contract that one of our key goals was to create a culture of growth and experimentation at the business, so company wide. And it was cool. At the Growth Hackers conference, maybe 2 years ago, I introduced their worldwide head of digital marketing. And one of the first things that she said to me that really separates Dropbox from almost any other company is that everyone in the company takes ownership of growth. And so I think that is, that's something that I've kind of strived for ever since. And it's interesting. So by the time I left Dropbox, I was there for 6 months. It was another 9 months before they brought in a new marketing head. It took them that long to kind of find the right person. And their experimentation didn't slow down at all. Their growth curve trajectory stayed really strong. And in fact, they announced a couple of years ago that they were the fastest SaaS business to reach the $1 billion revenue run rate. And I think it was just a function of everybody knowing their role in growth, pulling in the same direction, and just being really, really united around, test, learn process to accelerate growth in the business. Lookout would have been probably one of the hardest ones that I did. And so one of the things that I always said, like, if nobody wants this product, I don't care how good I am at marketing, I'm going to fail. And so I came up with a question pretty early on, kind of in between Dropbox and LogMeIn. I was working on a company called Zobni for a little bit. And the question was, how would you feel if you could no longer use this product? And, what I found, like, with the fast growing companies, that a pretty high percentage of people said, I would be very disappointed without this product. And so it's a really kind of good early indicator. Okay, people do want this product. Now it's an execution challenge. And so I went into Lookout, and I'd actually committed to work with them for 6 months. And I ran that question, and only 7% of the people came back and said they'd be very disappointed without the product, where, I was looking at 10 times that on my previous project that I worked on with Eventbrite. It was about 10 times that. And so I'm like, oh crap, I probably should have asked this question before I committed to 6 months. But we were able to move that to 40% in 2 weeks. So kind of crazy. But what we did was we studied the 7% who said they'd be very disappointed without the product. We learned their use case. We learned what the key value that they got from that use case was. We repositioned on that. And then we streamlined the onboarding to the experience that really quickly delivered on that benefit. So we set the right expectations, so set a promise of the right experience and benefit that would be delivered, and then really work to get people to that. And so just surveying each new cohort of users that came through, we were 40% in 2 weeks. And then 6 months later, when I left the company, it was up to 60%. And a couple of years later, they announced funding at $1 billion plus valuation. So I think being able to really tap into what makes a product valuable is absolutely critical to driving long-term growth in the business. So I think you're on mute.
Good point there. I was worried. I was worried about Betty barking. But yeah, a couple of questions. So first, with that last point around, asking that question, how would you feel if we took the product, if we were no longer able to use the products, right? And that is a question that certainly some smart SaaS companies and many use to kind of gauge whether they found product market fit. Sort of these days, it's kind of like almost like a benchmark, right? But what percentage do you need to kind of have to realize that if you do have product market fit or not? And then how often you use an example in terms of you surveyed or asked that question a number of times in a short period of time. How often should SaaS companies really be asking that question?
Yeah. So one, a couple things. So I think retention cohorts are actually a better measure of product market fit than this question is. The problem is with retention cohorts, you don't actually know the why behind why people keep using it. So when you ask this question, you're able to hone in on the people who say they would be very disappointed and learn everything you can about them. But what I've historically found is that around 40% of users, when around 40% of users say they would be very disappointed without the product, I could effectively grow those products. But what's interesting, if you actually look at from a retention cohort perspective, which is probably more telling, and you say, okay, that would suggest that like 40% is the right retention cohort. But if you actually look at successful companies, for Netflix, it's about 20% of their mobile users anyway become long-term retained. For a company like Instagram, it's 40%. Other products are going to be higher. Calm, which is $1 billion app, is only like 2 or 3% long-term retain. So I do think a little bit is there's probably more nuance than the 40% that I usually talk about. I just, to me, I think that what's important is that companies should set a target and work for that target. And then from that point say, okay, we probably are in a position where we can grow this business. The benefit also of having it as a survey question is that it's more of a leading indicator. If you say, okay, I need to make sure that I have really strong 6-month retention cohorts. What do you do during those 6 months? Do you bring in a batch of users and then wait 6 months before you do anything? Or do you bring those users in, track the retention cohorts, and then try to grow that business? So either one of those is probably not the right choice. So being able to ask people in that cohort how they would feel if they could no longer use the product gives you kind of an early indicator if they're likely to stick around and use the product. But so, I do think so. And then the other question you asked was sort of the frequency of asking that question. So first, you probably shouldn't be asking the same people the question over and over again. So it's really, sampling your users. How often should you do that? I would actually do it for an early stage business with every single release. So every release, new batch of users on that release, see what the change is. And then for, or if you made a major positioning update or something that you would expect that could drive some change. And then, for established businesses, you might be able to do it once every 6 months. But, I think a lot of people think of product market fit as primarily being a startup thing. But, if you take like some of the old video rental companies or, things that, even like taxi companies that, at one point they probably had great product market fit, and then the dynamics of the market change. And so even if their product doesn't change that much, the alternative products change. And so you may slip out of product market fit. So the more that you monitor that, the more that you can hopefully refine product market fit and not have the market leave you behind.
On the earlier point around creating a culture of growth, that could be a whole other podcast topic, which we won't do certainly today. And I think actually SaaStock EMEA, we've got Dylan Field, the CEO of Sigma, talking about exactly that, which I'm looking forward to. But like, so you mentioned at Dropbox, everybody kind of owned growth, or it was something that you helped kind of bring in, right? And actually made me think when you were saying that, I remember that with Stripe, for instance, that, you know, a few years ago, I was trying to look for the right person on Stripe to sell sponsorships for SaaStock, right?
Yeah.
And everybody on LinkedIn was growth at Stripe, growth at Stripe. And I was like, don't they have any like marketer, like, you know, somebody field marketing or anything like that? You know, it's driving me crazy. But that kind of like penny just kind of dropped when you were talking about that. But you know, there's Dropbox and there's Stripe, and there's two like huge companies, huge valuations right now. And they have a culture of growth. But should every SaaS company have this culture of growth, or do you have to be a specific type of SaaS company?
I think, I mean, so it's really the question of what is growth. And, you know, to me, growth is impact, really. Like at the end of the day, I create a solution for people who have a problem or have a need. And if I create the world's best solution and it doesn't reach any of the people who have that need, the impact is zero. And so impact happens when the right solution gets to the right people. And so who doesn't play a role in either building the right solution or getting it to the right people? Almost, I mean, you might say, okay, finance doesn't, but even finance does in some sense, that they're, you know, funding the efforts. They're funding the teams that do the efforts. Maybe legal doesn't, but you know, they can create a lot of bureaucracy in being able to run a test learn process. And so really everyone does play a role. They don't need to carry a growth title, but I think one of the breakthroughs that helps companies work together effectively around growth is just, you know, coming up with a metric that really captures that impact. And so in the growth world, we call that a North Star metric. And so for a company like Uber, it's weekly rides. You know, they know every time someone takes a ride in an Uber, a driver made some money and a rider got where they needed to go. So instead of optimizing for app downloads or rider signups or driver signups, all of those are sub metrics of this weekly rides metric. And so, you know, that's something that they report across the table. And so on my podcast, the Breakout Growth podcast, I interview heads of growth or even CEOs, a lot of companies, and all of them are really fast growing companies. And almost all of them, whether they call it a North Star metric or not, have a single metric that everyone in the company is working toward. And I think that's when, you know, the opposite of everyone pulling in the same direction is that kind of siloed organization where my metrics that I'm trying to grow maybe are like leads on the marketing side, and then the sales side is a lead to sale ratio or an average transaction size. And you know, the more leads I push in, I'm going to maybe bring that average down. And so you get these kind of like tensions that exist, where if instead everyone is thinking of themselves as a role in moving the impact metric, it's a lot easier for teams to work together effectively in doing that. And then the next kind of piece to get everyone on the same page is having a shared view of what the engine looks like that moves that metric. And so if you can kind of collaboratively design that, and that's what I do in a lot of my workshops, is I come up with the metric, work with a team to collaboratively design the engine that moves that metric. And it's less about designing, I guess, but it's more collaboratively understand the engine. But when you have everyone on the same page around how that works, it's just a lot easier to get everyone working together to improve it.
What are your thoughts on growth at all costs, which we've seen a lot of, certainly in SaaS companies, you know, in the past, maybe some still today, versus sustainable growth, which you're hearing a lot more about in 2020?
Yeah, I think, you know, so for me, I've always been about sustainable growth. Like for me, I'm always constrained by what is my return on investment, even at times when other companies were not doing that. So, you know, in the late 90s, where it was like, if you were profitable, there was something wrong with you. We had the lowest customer acquisition cost of any publicly traded company for a free registered user. We were like $2. Yahoo was considered one of the best at the time. They were about $30 for a free registered user. I mean, I think we may have been $4, but we we were still just a fraction of what everybody else was doing. And we had television advertising. We had some things that pushed that average up quite a bit. But and then even with LogMeIn, we were cash flow positive from kind of the minute that we tried to scale that business, and stayed cash flow positive. Dropbox, the same thing, was cash flow positive for most of its scaling. And so, that's to me, economic constraints are a good thing. They actually can help you grow faster, because the problem is when you're not kind of constrained by the economics, someone comes along with an opportunity that says, I can give you 20 million people, and you suddenly kind of look at it like, oh gosh, I don't know if I'd be wasting my money on those 20 million people. And so it kind of like freezes you if your growth at all costs, where if you know what your economic constraints are, then you run as fast as you can within those economic constraints. The one exception that I would say, and I just haven't worked in that environment, is a real network effect business where it's maybe a winner take all. But even like in that case, I think like Uber versus Lyft, we're seeing that it's not really a winner takes all. So it's pretty rare that it's a winner takes all anyway. And then the other thing that I would say from if you're investing in growth and you're doing it on an ROI positive approach, and you've got yourself a payback window. So at LogMeIn, our payback window was 3 months. We wanted to be fully paid back, and then everything else was profit after that third month. We were able to cycle $1 million a month on advertising with that 3-month payback. But ultimately, at LogMeIn and pretty much every other company I worked on, the majority of users came through word of mouth. And so in addition to that 3-month payback on tracked paid acquisition, we had amazing organic growth, because it was really about building a flywheel around understanding how people get value from the product, getting a lot of the right people to that valuable experience. And you naturally unlock a lot of word of mouth with that. So I think at LogMeIn, we were about 80% word of mouth. Dropbox, with all the kind of viral mechanisms and everything else that was there, word of mouth dominated, any of the kind of collaborative spreading that was in Dropbox as well. And so I see that on almost every company. If your growth engine is around getting the right people to the right experience, usually that's a big multiplier on anything you're doing to drive growth. So I'm all about sustainable growth, and that's actually my topic at the conference.
Speaking of growth engines, before we talk about your talk at SaaStock EMEA, what would you say the most important elements for startups who are just getting about building their growth engine?
So I've touched on some of them. So I would say that product market fit is absolutely critical. You cannot sustainably grow without product market fit. And that's best represented by your ability to retain the users that you've acquired. You're not going to retain everybody. If you lose everybody, though, if you have essentially, after a certain period of time, every single person you acquired disappears, you cannot grow that business in the long term. So you need to be able to have long-term sustained retention of a percentage of every group of people that you acquire. And whether that's 20% or 40%. So some of the examples that I gave you, that can be all over the board. So you need to figure out kind of what the right pattern is for your business. Another thing is just, I've talked about the importance of tracking and data. Like you cannot improve what you don't understand. And so having really good tracking in place, and there's kind of no excuse not to have good tracking now when products like Amplitude are free for 15 million user events per month. So you're never like too early for that kind of tracking system. You can afford free, and it's maybe a day to set up the instrumentation. I'll admit that I've run up against like, oh, we're so busy building product, we don't have time to instrument the tracking systems. And but that you should be able to make a case that flying blindly is not going to get you anywhere. And then the test learn process is really critical once you understand value, once you have the tracking systems in place. Oh, the one other piece that I would say is that a key requirement is not just the quantitative data side, but the qualitative side. So I really learned this at LogMeIn. I had a venture capitalist who kind of kept asking me, when was the last time you talked to a customer? And I finally got frustrated and told him, I don't care what they say. I care what they do. I track everything that they do. I test everything, try to change what they're doing. It's like, okay, that's nice. When was the last time you talked to a customer? I need you to talk to customers. And so I kind of just, humored him after a while. Just, he's the investor. I'm going to make sure that the answer is always today if he asks me. And an interesting thing happened that the more I talked to customers, the better my tests got, the more kind of plugged into the real world situation was. And then I got much better at surveying. And so when you can bring together qualitative insights with quantitative data and testing to drive improvement, that's a pretty powerful combination.
Yeah, I read, certainly this year, a way to kind of get a pulse on your business is you speak to two people, your customers and your employees, right? And if you're not doing either, then you're certainly missing out.
Especially if your employees are talking to your customers, then you can get a really good pulse.
Yeah, exactly. And they should be. And as you mentioned, you'll be keynoting at SaaStock CEO on Wednesday, the 14th of October. So really excited about that. You'll be speaking about sustainable growth.
Yep.
If it's possible, what is at least one thing that delegates and attendees will get from listening to you, watching you at that talk?
Yeah, I mean, I think I've touched on a lot of what drives sustainable growth, but one of the most important concepts that people should come away with is know what a North Star metric is, figure out your North Star metric, and use that as your guide as you're executing that North Star metric. If it's tied to how customers get value from your product and everything you're doing is about accelerating the amount of value that you're delivering across a growing user base, your growth will be sustainable. Obviously, if you're constrained by positive return on investment as what drives your customer acquisition, that's a huge part of sustainability as well. But I think a lot of times people get caught up in sustainability as primarily being about sort of the economics of sustainability, but economics of sustainability that aren't focused on just maximizing the value that you deliver to your customers. You can have economically sustainable growth curve that was profitable all the way through, but then crashes because customers don't stay long-term retained. And then that's just not a sustainably growing business. So it's actually probably from a sustainable growth perspective, value plays more importance than economics, but economics are really critical to not, if you're a VC-backed business and you're just pouring money into unprofitable customer acquisition, then you're going to dilute yourself down to the point where you have, not much equity left in the business and you're reliant on venture capital. And when you try to wean yourself off of that, you may not be able to grow within the constraints of positive return on investment. So I prefer to have that constraint right from the beginning.
Awesome. Well, super excited to watch and learn on the 14th of October at SaaStock EMEA there. Final question, Sean, as we come to the end of the show. We always ask our guests how they stay healthy and sane. What's your way?
Well, especially these days, pandemic healthy and sane is a whole different ball of wax, but I do meditation every single day. That really kind of helps on the mental health side, and I think it just helps me be a lot better at my job. And I notice my productivity for 10 minutes of meditation, my productivity way more than makes up for those 10 minutes. And then on the kind of physical side, I'm going to play soccer this afternoon, I guess in Europe football, but I tend to play 4 days a week, soccer and surfing, except I just messed up my shoulder. So I haven't been out for a little while. So hopefully my shoulder will get better soon, because surfing's super good on both the physical and mental side of things. There's some zen that you get out on a surfboard that it's almost impossible to get anywhere else.
Awesome. And Sean, where can people find you online?
So SeanEllis.me is my site that kind of points to my podcast, LinkedIn, anyone who wants to connect with me, just say you heard me on this podcast, and I'm happy to connect with anyone who reaches out from that. Biggest thing is normally what you don't generally have on a podcast like this is a bunch of vendors reaching out who then try to sell you all the time. That's no fun. But yeah, and then check out the Breakout Growth podcast, and go practice all of those things.
Awesome. Well, Sean, super excited to see you at SaaStock on the 14th, and thanks so much for sharing so much knowledge today with the SaaStock community. Really appreciate it.
Of course. Thanks, Alex. I appreciate you having me on.